when I think financial advisor, I do think old man in a suit. I can't see any of my friends at any level of wealth speaking to a financial advisor.
Welcome to Advice Amplified. Today's guest is Tej Singh.
As you know, if I have 100 grand, I can put 100 grand in stocks and shares. If I have 100 grand, I can buy 400 grand's worth of property.
Is there like a clear way of almost mapping out the different strategies and where they sit on that kind of risk spectrum?
I think, and to be fair, people don't even need to map it out because I can just tell them. The top is, I hope that land reg and solicitors all lose their jobs. And what I mean by that is, it makes me laugh and it's fun, and hopefully that clip there will get people riled up because then they can come comment on my post and we can talk.
Tej knows so much about property. I found it really interesting to talk about this. It's something a little bit different for us. It'd be great to know your thoughts on who you'd like to see on the podcast in future and some topics you like discussing. So please drop us a comment and give us a like if you can. Thank you. Tej, welcome to the podcast.
Pete, thanks so much for having me.
Awesome. I've been really excited for this chat. I was thinking in advance that whenever I talk or mention I'm a chartered financial planner to people at parties or in the pub, which I do way too often, they kind of always assume, or the conversation always goes towards investing, which means property or crypto or even buying art or cars or something like that. Rarely does it go near kind of like regulated investments like pensions or funds.
Yeah,
that always really struck me when I was doing my financial planning exams, that they cover all of the different like UCITS and bonds and all this kind of stuff, but they never really talk about actual investing the way people, I think, would think about it. So I was really keen to kind of get your take on property versus equities and when they're right, when they're wrong, and just generally how does that kind of play into the sphere of personal finance?
Yeah, I think property has a few things about it which make it quite magical, and one of them is leverage. As you know, if I have 100 grand, I can put 100 grand in stocks and shares. If I have 100 grand, I can buy 400 grand's worth of property, right? And on a 25% and 75% bridge or mortgage. And so instantly I'm quadrupling what I can like achieve in terms of what I can buy. And obviously on a residential scheme, if I have 100 grand, I can potentially get even more. And so for me, I think when you're starting out and you're trying to, really start to generate, not maintain, but generate, build, scale your wealth, whilst also having assets, whilst also having cash flow, I think property for me makes sense because, you mentioned what's right, sort of the right times. I just think that makes more sense because you can do a lot more with what you have and you're in a lot more control of it. If I put 100 grand into stocks and shares, equity, crypto, whatever, I can't influence, Meta or Alphabet, what they do really, right? And so yes, I'm probably going to get a good return, 8 to 15%, whatever I've been seeing. But I can't do anything about that. My money is in it. I can't recycle my funds. But with the way I and a few others do property, you can recycle it. You can take that money out. You can create equity. So I do like stocks and shares and I invest in them probably nowhere near as much as property, but it's there. It's passive. I check it. I don't know, when I remember. It's very much set and forget. And for me, those are the kind of differences. And I only really started investing in them heavily when I wanted to maintain wealth after property.
Super interesting. So property is more of a wealth creation where you can actively make something happen, I guess.
Yes. And it's in your control. You can borrow money in property from investors, from bridges. Whereas, if I said to someone, hey, give me 200 grand, I'm just going to chuck it in, free trade and see you in a couple of years. It's like, huh? But if I say, hey, I'm going to buy a property with it, refurbish it, sell it, take the profit, do this, it just becomes a lot easier to borrow that money. And then actually you can use it in a sense. I don't really think you should be taking borrowed funds, putting them in there. I know that's what all the large funds do, but you can't guarantee a return of a certain level. Whereas in property, I can get myself this return. I can give you this return as an investor. And I have the middle and we're both happy.
Interesting. And I suppose, because there's that argument as well, isn't there? And I suppose you're making this point that investing in the stock market is fairly passive. You chuck some cash in, there it goes. Whereas property and probably other, like literally having a job, I guess, or starting a business, property is kind of in that space of there's more opportunity, but you've got to do some more stuff.
I like a million times more stuff. There is the only passive thing in property is if you give me money, I do the work, you get a return. That's the only kind of way it's passive. And yes, my portfolio is passive, but there's the odd text, the odd boiler breakdown, paperwork, kind of bits like that. So yeah, in order to make property work, in order to get those higher returns and to get that leverage and maximize it, you have to know a lot of stuff. You have to be able to put it in practice, have the time, the network, the knowledge. I mean, it's 100 and 0 in terms of like, not 0, but 1 and 100 in terms of effort needed, especially with like Nutmeg, Money Farm, Moneybox, etc. With the bot AI investors, it really is like set and forget.
And how do you kind of reconcile that kind of need to consider personal finances across? So you've got to understand debt, you've got to understand investing, you've got to understand some of the legal side of purchasing a property, and then probably ISAs, pensions as well. I suppose the financial advice industry kind of, from my perspective, almost ignores a chunk of stuff. And then, there's all this other stuff that, like, how do you create a well-rounded strategy to engage people about this stuff?
I think what you kind of said there about being well-balanced and well-rounded is the key. So for me and a lot of people, and I'm sure studies have shown this, that we value not losing over winning, right? We'd rather protect than we'd, have a moonshot. And so I think when it comes to creating your portfolio of investments as a person or as a business, I think risk mitigation is a big part of it. So if you know that, right, you're doing land development, which is the riskiest and the highest rewarding property strategy. Well, if I'm doing that and I'm only doing that, okay, but then maybe I shouldn't be investing in, what penny stocks, whatever they're called, on the AIM market for oil exploration companies. Because I've got so high risk here, I don't need that here. Maybe I should be boring, put it in a tracker ETF and leave it there. But if you're doing vanilla single let buy to lets, lowest risk, lowest return arguably, maybe we'll do some crypto. Maybe we'll do some of the oil exploration companies. Maybe we'll go a bit crazy with that. And so I think it's, diversity, the cliche thing, isn't it? Diverse portfolio, right? That's what you should have. And it depends on your stage in life, i.e., if you're creating wealth, you can be more focused on property. Maybe as you get older and generate more wealth, you're going to be focused on maintaining it and kind of slowly growing it. You might also look at investing in companies, investing in other people's real estate projects. You might look at, like cars, art, wine, all sorts of things. But I think the underlying thing is risk mitigation, which is, yes, they could all moonshot in some crazy world. They could all do amazing things, but let's assume it's 8 to 12% a year. But what is that risky thing over there? What's the negative on that? If that's minus 12, it could be, have I got enough here to kind of buffer it out? So I think it's like hedging your bets, which hedge funds, I suppose they literally do.
Is there like a clear way of almost mapping out the different strategies and where they sit on that kind of risk spectrum as pertains specifically to property, I guess?
Yes. So I think, and to be fair, people don't even need to map it out because I can just tell them. The top is land development. So getting some mud, getting a field and turning it into houses. There's risk in planning. There's risk in the builders. There's risk in who knows what Roman remains you're going to find in the ground. Who knows what contaminate. There's just 1,000,001 things in the ground, literally, before you even get out of it that cause such a large risk. But the reward is a lot of zeros and people get drawn into that, but they don't want to see, as humans don't, they don't want to see hard work. Oh yeah, it takes 2 years to get planning sometimes and then another 2 years to build it. But all I see is zeros. It's the hardest thing. And I'd probably say commercial conversions is below it. So almost what we're sitting in now is a commercial to commercial conversion. This would have been print room. So it would have been an old printing factory of some type. And now it's converted into commercial units. This is risky. This carries a higher cost. There's a lot more regulations with soundproofing, with fire, with sprinklers, with AC, but there's so many other things that can go wrong. It's slightly less de-risked because you've got the structure, you've got kind of things here, but that also limits it in terms of your imagination. If you give us a field and we go crazy, we can create any sort of grand designs thing. In here, we can, this is a cool building, but we are limited by that huge steel pillar there. We are limited by all these things. So that lowers the risk a bit. And then I'd probably say HMOs are kind of next. And I'd say, so houses are multiple occupation, flat shares, 5 people, 1 house, for example. And you can get 40-bed HMOs. You can go crazy with it. The gap between HMOs and development, so commercial and like land, is quite big. It's not just, those two are, but the jump from HMOs is high. HMOs has, red tape, has councils getting involved, building regs involved. You're converting a flipping 2 up, 2 down Victorian terrace to a 4-bed, 4 ensuite, soil pipes running everywhere, water everywhere. It's, you're taking something small and cute and turning it into a beast. So, and there can be issues with neighbors and tenants and things like that. So that's there. And then I'd say flips, so buying to sell, can kind of be similar to HMOs or just below. It's a lot simpler. Taking a 3-bed, keeping it a 3-bed, making it gorgeous, blah, 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 maybe opening up, putting some steels in, and you're selling it. And then you have buy, refurbish, refinance, which is what I do, which is slightly less risky than flips. Depending on the market, they sort of, switch with each other. And then at the bottom, you have the traditional way, which is there's a house, it's all kind of all right, it's kind of got tenants in, whatever. I'll put 25% down on a mortgage and I'll leave it there. And I'll wait 7 years until my salary gives me enough to buy another one. And I'll do it again. And then I'll just sit there. That's the kind of, and then there's like rent to rent, deal sourcing, whatever, which is, I think, below all of that in terms of risk.
And how has your kind of journey through those different strategies materialized? Did you start, I guess, at the simplest and work it up, or jump around and settle down in one place?
So I was going to start with rent to rent, and it's a great strategy for kind of short-term cash flow and quick cash flow, because property is so slow, so antiquated. It's just, everyone is just so slow, and I don't know if it'll ever change. But rent to rent can get you started pretty quickly for a couple of grand. So, not a real kind of heavy outlay. But I actually stopped doing it because I just didn't need sort of to quit my job, or I didn't need a quick way out. I had savings, I had a business prior, so I actually kind of did some viewings, nearly had one, and thought, and this is something that everyone needs to think, why am I doing this? Like, I don't need this cash. I mean, who says no to cash? But I thought, I don't need the headache and the cash from it. I should just go straight to BRR. And yeah, I might only have this amount of money to start with, but surely if I raise investor finance, I could have $1 million to start with, or, at some point. And so I stopped the rent to rent and went straight into BRR and flips. And I have looked at and considered land development at the top, but I like the path of least resistance to the most result. And land is not that. Land is the most resistance to the most result, which is fine. That's in equilibrium. And I looked at some commercial conversions. I didn't want to do HMOs because of tenant issues. So I haven't jumped into each one myself, really. I've done it through my network or through deal analysis or through, speaking to people, listening to podcasts, understanding what's that strategy really like from people who tell the truth, because social media is full of liars, especially in property, you are. And I stuck with BRR and flips, and I still do them, and I won't go any higher unless there is some sort of standout opportunity that's put on a plate, because I like the simple but elegant, minimalist, chunks of cash from a flip. I like the BRRs, pulling my money out, creating all this equity, just sitting back on a beach. That's the dream, isn't it?
Yeah, for sure. And I suppose you mentioned, there's so much complexity in there. There's loads to learn in terms of regulation, like how to raise finance, how to manage that. Mm-hmm. I suppose, where do you stand on the current kind of state of regulation in this market? So should people require, qualifications, or should there be more governance around it, like there might be in, I suppose, the government's trying to introduce with crypto, or there already is with some of the like equity investment. Like, have you got any thoughts on that kind of stuff?
I think the current regulation for it is just a bit of a paperwork exercise. It's very easy to say I'm a high net worth individual. If I sign it and I send it to you, that's that. Like, what I mean? So I think at the moment it's there, and it's a bit of lip service, and, do the FCA, get involved when things go wrong? I've seen people in property, like kind of big names who owe millions and millions, kind of go bust, something happen, and the FCA aren't really anywhere to be found. Everyone's kind of, they're there. There are kind of overlords, but they don't seem to help the people who've lost money, and they don't seem to actually get involved in that. So maybe they're busy on the bigger scale of things, right? I think people need to be qualified, but not necessarily with like an old school, degree or like a course. I think the FCA themselves should, so I've done an e-learning course on FCA regulations from an ex-FCA lawyer, but the FCA themselves and any institution involved should make an e-learning course for free and say, right, if you were raising finance for a fintech startup, for property, whatever, here's our rules explained. Because what they currently do is send you this humongous document. I'm sure you've seen them. It probably makes a lot more sense to you. And you're just like, okay, so I can do this, I can't do that, but I can do that, but I can't. So most people just say, fuck it, I'm going to do what I like. It's kind of like whatever. So I think, I don't know if there should be more regulation. I think there should be more protection and there should be more education, because that education would mean that people don't make stupid investments, because I blame the people who made the investments too, because some of them are just making dumb decisions as well as the person going wrong with it. I think that would help more. And I think in general, the government hate landlords, even though we house everyone they won't house. We build social houses. We build more new builds every year, even though the government try and stop us with planning departments, but they still hate us, but we do their job for them. So there's regulation in that sense, which is irritating more than anything. And EPCs, trying to make us super environmentally friendly, which is great, but also who's going to pay for that? Because you can't afford it for certain properties. So there's other regulation that's irritating, annoying, and just the government just being themselves. And then there's the financial stuff, which I think just needs more education.
So yeah, I'd be really interested to circle back, and this is, to be honest, selfishly for my benefit. So you mentioned buy a refurbish or refinance. Like, how does that kind of stack up as a strategy? What does it entail? And I guess what are some of the things to be aware of?
The traditional way I kind of said before, buy a house, put a deposit in, leave it there. Your equity is at 25%. In a 100 grand house, that's 25 grand. That's going to sit there forever. The house will go up in value, of course, inevitably. You might be able to pull some back out at some point. Then your mortgage goes higher. But that 25 grand is in there, which not a bad thing. If I put 25 grand into something and I can make, 400 quid a month net profit pre-tax, it's not a bad return. Where else am I getting that? Not from the bank, and I'm not owning an asset that's gone up in value. So when you kind of look at it, even though I'm against it, it doesn't make any sense to me. Even more so if it's a new build you're buying, because it's already at a premium and they're so terribly built, most of them. It does make money. So I have to say that caveat, that does make money, and that's cool. And if you have £4 million in the bank, why would you bother refurbing 40, 50 grand houses in Durham? You wouldn't. So for some people, just buy houses, chill, rent them out like celebrities do, like these famous people who buy houses. I don't really think they're doing BRR. But for most other people, the buy, refurbish, refinance model allows you to, for example, put a deposit in, whether it's yours or whether it's an investor's, family member, friend, postman, whoever. Put the money in, do a refurb, force the value, so increase the value of that. So add that appreciation to it now, not in 10 years. You'll have that anyway, but add appreciation to it right now. And then in 3 to 6 months, call a mortgage lender and say, hey, I've got a brand spanking new house. Everything is done, blah, blah, blah. And yeah, they'll know you bought it for 40 grand and it's now worth 100. That's fine. Most lenders are fine with that. Some are just weird. They come in and say, oh, yeah, nice house. Like it. That's worth your new value of 100 grand. We'll give you 75% of that as a mortgage. You say, great, cool. They then give you 75 grand back. So that, if the maths is mathing correctly, you then get your deposit back, potentially, some of it, all of it, right? And you get all that initial bridging loan you had to use or investor finance back. So if I put in a mathematical example, so we buy a house, we know the end value when it's all done up is going to be 100 grand. We looked at stats, data, we're fairly confident. So if we want a pure BRR, like the gold standard, which is no money left in, we have a budget of £75,000. There's a few fees, but give or take £75,000 is all we are allowed to spend to buy it, to refurbish it, for stamp duty, for legal fees, broker fees, everything. So let's say we buy a house for 45 grand. 45 grand, it's a shithole, it needs doing, blah, blah, blah. Then we spend 30 grand on it. So 55, 60, that takes us to 75 grand. So we're all in, bought the house for 45, spent 30 on it. It's looking nice. We've finished the house. You and I are happy, good to go. But we've both put in, at this point, 75 grand of our own money. Let's just keep it simple, our own money. Well, you and I don't really want to leave it in here because we've got other projects, we've got other things. We want our money back. There's two things. We can sell it for 100. We'll make 25 grand profit, 12 and a half each. Cool, we're happy. Or we refinance it at 100 grand. Mortgage guy comes along, valuer comes along. Okay, cool. Give you, 100 grand valuation, done. Doesn't always happen that easily, but let's say it does. They give us £75,000 to refinance, to remortgage, to pay off the initial finance, which is you and I. We get 75 grand back. You take your cut, I take my cut. But hold on, we now own a house that has no money in because we've just got 75 grand back, we've got a free house. But also, both of us have that 25 grand of equity, I said, because it's worth 100. So let's say we refinance it. And in 6 months, you say, oh, Ted, you know what? I don't want to do this anymore. I say, yeah, whatever. I'm leaving the country, whatever. And we sell it. We've made 25 grand of profit or more because it goes up in value. And we had a free house. That is the magic of BRR. When it goes perfectly like that, and it has for me in maybe 70% of occasions, you walk away. Even now, I think, how the hell have I got a house where I've locked in that 25% equity that's not mine? I've got all my money, my investors' money back out. What the hell? Like it's an incredible strategy when it works. But as you mentioned earlier, layers and layers of complexity, issues, challenges, finding the deal, managing it, refurbing it, endless issues. But when it works, it works.
Yeah. I suppose the truth in there is you've created value.
Yeah.
And, it feels like money out of thin air, but actually you put a lot of hard work in there.
Yes.
And I suppose that's the thing that people walk past sometimes.
And you forget that yourself. You look back and think, damn, you just forget I spent 3 months of dealing with builders trying to put nails in my eyes. And now I've got a free house, and if you use investor finance, it's not you and I that's getting paid off. It's my investor. So he gave me 75 grand. I did that deal in that example. I've then paid him back 75 grand. And I've got a free house that I put no money into because I could pay his interest from either the rental income or if the remortgage is really tasty, I can pay his interest through there because I factored that into my deal and how much money I'm leaving in. So with all my properties, since the third one onwards, it's been investor finance. I've put nothing in, even with my flips, I put nothing in, did a house, 35 grand profit, literally from thin air, but I didn't put any money in. When it works, it works.
And what are some of those cases when it doesn't work? Is it the refinances side struggling, or just getting a bit too hungry on the way in and maybe not waiting for the right property? Or
you know what? It can be that one. I haven't ever had that. I'm very, very strict. Very, very strict. And I think I'm a kind of good negotiator because I've had some direct-to-vendor deals where you could kind of be a bit more creative with it. I wasn't creative with it, but at least I got to sit down face to face with the owner and say, let's make a deal. That is definitely something that happens with beginners. With my mentees, they come to me and I say, I know you're hungry and I know you want this, but are you getting out of bed for a 10% return after 3 months of hard work? Let's kind of look at it realistically. But the most common issue, apart from user error, people getting deal analysis wrong, being too hungry, is that the RICS valuer comes along and says, I don't think it's worth 100. I think it's worth 90. And you're like, here's 10 pages of data to say it is. Yeah, but I've got a degree and I know management. Fucking valuers. I honestly hate valuers. Sometimes they've got it right, but a lot of the times, we and any developer who does refinances will tell you this. We have all the data. We follow the rules that Rick set out for. This is what we look for, but we still get downvalued. Sometimes it's the lender saying, we drop it because of our insurance or because, we want to be less exposed. There's always games and corruption and brown envelopes and all sorts of stuff flying around. But that for me has been the single biggest issue because they come in with that. You can appeal it, but is a valuer ever going to turn around and say, I was wrong? It's their insurance at risk. It's their reputation. It's their never. I appeal it just to piss them off. I know I'm not getting overturned, but I'm like, here, you can read this 10-page report. Let's go. You can go to another lender. It may potentially use the same valuation panel or valuer, same problem. You may not have a bunch of different lenders available, depending on you, the deal, etc. So valuer's biggest pain in the arse, if you get downvalued, you either sell it and just say, you know what, I can always sell it for more, make a bit of money, or you accept it, which I've done before, and you leave a bit of money in knowing that in X many years, it will be revalued. I had one revalued, it's one of my service accommodation units. I think it was first valued at, I want to say 85 or something. And I was like, this is pathetic. And just recently it was valued at £110,000. My first ever property was valued at 80, which was fine. Now it's 120. It's only 3 or 4 years. So valuers, absolute pain in the ass.
When it comes to educating yourself on this stuff, it's really easy to get sucked into misinformation or I don't know, I don't want to say scams, but just
scams,
dragged off the way. What's your like top advice, or how would you, if you're fresh and just coming into this, where do you go? What do you do? How do you avoid kind of the bad stuff?
Oh, there's so many things. Okay, so 90% of people on social media are lying. That's the assumption you have to have. Everyone is guilty before innocent. And I'm saying apply the same thing to me as well. There's loads of things. The first thing is though, to people, look, yes, you want to quit your job. You hate this. You want to get into property and become a millionaire overnight and just do the free stuff first. Listen to my podcast. Listen to property podcasts. Once you've kind of done that, YouTube, etc., and you're still like, you know what? This sounds like an absolute headache and hard work, but I'm still keen, because 90% of you will just drop off after that stage, which is good. Like, see you later. The ones that stay, then you go to the sort of 20, 30 quid mark. Books. I've got 2 books on Amazon. Go buy them. 30 quid for both, will be less. There's maybe 15, 20 other books. Just buy them all. Some are going to be shit. Buy them all. Read them all. And then if you're still crazy enough to be like, yeah, property sounds really good. I really want this headache. Then you should start going to networking events. Then you should, because they're like 15, 20 quid. But then you should start, or you could probably do networking events during the reading. Then you would consider the heavy paid stuff, which is thousands of pounds. Education, mentoring, etc. But people should only consider that once they've done those beginning stages. I want everyone to get the BS out the way, get the basics out the way first. And then when you're really, really ready and you've proven to yourself and you know that, yeah, I'm game for this, then we can do that. When you're following people on social media, look out for claims, because people like to claim you can be financially free in a month or 2. Okay. Now, if you don't know property and I tell you that with enough confidence and enough lifestyle around me, why would you not believe me? Like, we're humans. We want to believe each other. But people have to take some self-awareness and some, kind of self-reflection and say, so there's a bunch of people here being flashy saying you can do it in 3 months. And there's some people here saying it's flipping hard. It takes all this time. Why would people talk about how hard it is? Because, like, for example, for me, if I spoke about how easy it was and that you could do it quickly and I'll promise you your first property in a month, I would sell a lot more courses and mentorship. I know I would. I'd rake it in. So why are people talking negatively and about the challenges? There's a reason. And there's a reason people are being super positive and not talking about it. Because everything is hard and everything is a challenge. I think also receipts. The amount of people who go online and say, I made this money, I made this, I have this, I have that. You go on company's house. There's no companies. There's no charges on the register. If you go on my thing, you'll see 17 different charges. Probably more, actually. Some satisfied, some not. You'll see the address. Like, I've got receipts. You go on my Instagram, the bank statements are there. I'll show you the bank statements. Most property trainers will not. It will be a distraction technique. It will be something there. So if people are making claims, we make 6 figures, a month or whatever. Is that turnover? Is that net profit? Is that between 4 of you? Is that this? Is that... it's very easy to just put that on a TikTok and on a reel and say, because it sells. So receipts is a massive one, doing your research on people. One thing which always gets me is you need to feel like you can ask questions. If we're talking about my education, I'm saying you get this with it, you get this with it. You need to be able to say to me, Tej, hold on. What about this? What about that? What does this mean? Okay, how does that look? Oh, okay. You said, you're doing flips now. Why are you only doing flips? I said there should be a discussion. And if you're going to give me 100 grand to invest, again, you should be asking me, have my credit report, have everything, copies of my ID. Like, you should be able to ask me things. But I think a lot of scammers and a lot of the people lying, you can't. They're very good at NLP and sales tactics where you ask something and they just push to the side. And it's, good for them for being good at sales, but also there's the ethical point. So people should be comfortable asking questions. You should never feel forced into something. You should be like, okay, I've asked all my questions. He's answered them as I expected. There's nothing outstanding. I spoke to my mates, they're sort of positive in it. Okay, I have no objections. Let me kind of do this. So I'd say people follow that path, but also really assess, who you're buying into. I find a lot of people, and maybe not just property, but when people are, getting help for building their brand or websites or whatever, and I see who they work with and I just think, yeah, but that person's portfolio of designs is shit. And you want to build your brand with shit designs. Why don't you just do it yourself then? Like, why are you paying people to do something that don't do what they do or don't do what you want from it? So sometimes it's just a basic thing of like, can we use our brains here and have common sense? Take a deep breath, analyze it, put time in between the stimuli and response, and just use common sense. Nothing happens quickly. Nothing happens easily. We say this for a reason.
Yeah, that makes so much sense. And I suppose I'm interested in your like journey into content creation, and what was the motivation for that? Have you found it? What's some of the surprising things that you've learned along the way? It'd be really interesting to hear.
So when I started out in property, there were a few podcasts. A lot of them were kind of upsells. It was like a 2-minute interview, and then it was like, you're right, good. To learn more, sign up to our course, 6997, whatever. I get it. It's a lead magnet, but I think nowadays, especially with people like Alex Hormozy talking about it, the give, and then a little ask kind of model. And like Gary Vee had it with his jab, hook kind of model as well. That just didn't ring true with me. And also I wasn't learning. I was like listening to these podcasts thinking, okay, and then what? Or like, what about this? Or what? And it wasn't giving me what I needed. So I thought, start my own then. I'll build other people's brands in properties because they were so bad at building brands. And even now it's better, but it's not like a fintech where you're like, whoa, your brand is nice. Property developers are so frumpy, with a lack of a better word, with their brands. So I can build your brands. I can get to know you. We can network. I can learn from you. I can sit here and genuinely ask you like, what does this mean? What does that mean? Because I haven't got a clue back then. And that then became the podcast, Tej Talks. And then I realized, and even to this day, and you probably know this as well, with podcast, it's like a one-way platform, apart from YouTube, but an actual raw podcast is you listening to me. That's it. You can't comment, you can't like, you can share it, but it's not like Instagram or like a social media. Don't know why it hasn't evolved to be that yet. Maybe it will. And I then thought, I need something to drive people to the podcast. So the Instagram came, the Facebook came, the LinkedIn came, the TikTok then came, the Clubhouse came, and that died pretty quickly, although it's still going, apparently, I hear. And I then, from that, realized the benefit of standing out, of being different, of warming conversations up before we've even got into a room, getting free things, getting things at a discount, and then raising money for my property deals. I've raised just under £1 million from social media. Like, I haven't even met 90% of my investors, and probably won't ever meet them. Some of them are all over the world. I've probably made just past, more than that, more than 6 figures in my property education and mentoring business because of my brand, and the discounts, the relationships, the deals I found from agents saying, we were just speaking about your podcast this morning. And I'm like, well, come on then, sort me out. And with auctioneers. So, it's in the middle. And every single thing I've done or achieved or been successful with really has come from Tej Talks. It's come from the brand. So, people are scared and people don't want to create content and start their brand, but like, take it from me and anyone doing it. It takes time. There's that activation energy, slow. But when you're putting enough good content out there, yes, it costs money, or it can cost money. It costs time. It's like another full-time job sometimes. But if you want to achieve all these things, and in property, if you want to raise money and you haven't got a little black book of investors, it's the only way to do it.
I suppose it's just interesting as well to just be a part of sometimes, isn't it? It's good fun.
Yeah. It builds a community, you document, you get to speak with people who understand what you're going through.
Yeah.
Oh yeah, builder walked out on you. Yeah, no, it feels solicitor being slow. Yeah, so I think for your mental health as well, it's really good that it's almost like therapy talking to my Instagram story, because I know that most people listening understand it or want to understand it. So you kind of feel more heard when you're like sitting at home from, working alone, driving alone. It's just, it kind of helps in that sense as well.
So there's a thing I was keen to ask you or get your take on, that I don't know whether it's like a political question or like a socio-demographic, but and I think this pertains to like all types of business or like entrepreneurship or I guess people being successful. But there's definitely an undercurrent I notice, probably even in my friendship group, around like landlords and professional landlords and what that's doing to the price of the property market, and should they have participation when they're paying rent. And my stance is pretty straightforward on it. It's people working hard and deploying money they've earned somewhere else. That's a fairly straight and cut thing. But I wondered if you ever encounter that or have much experience or perception on it.
Every now and then I see a news article from like some stupid organization like the Daily Fail or like whatever. And I'll always comment on it because I know all the little vegans in Shoreditch are going to get, no offense to vegans, are on their little single speed bikes are going to get so like fucking in your face about it. So I leave a comment and I don't reply. And my comment, I would say, is not inflammatory. I would say it's like my opinion, which is inflammatory if you disagree with me. So I think there is a lot of rhetoric around, and that thing you mentioned there, which made me, I almost laughed when you said that, so I remember there was something about renters saying, participation. If we pay rent, should we own some of the property? You fuckheads. You're paying rent. You're not paying a mortgage. Like, sorry. Like, I go to Nando's. When I pay £12.50, should I get shares in the chicken farm in Portugal? What? Like, some of these things, I just think, you lot are just like being stupid, and then you're in a group of stupidity, and then it becomes a big clusterfuck of stupidity. Like, if I get it is so hard to buy a house. I'm a landlord. I bought 16 properties as investments before I bought my own home. And buying my own home was probably the hardest flipping one because of the mortgage rules, because of this, because of that, because of under. So I get just how hard it is to buy your own home. And I also get, especially in London, especially in certain parts, prices are going up, up and up. Landlords aren't responsible for increasing the prices. Inflation is, the world is, things go up every year. Employers not keeping salaries in line with inflation, that probably has something to do with, affordability, because houses are going here as they have done for years and salaries are just here. So who's responsible for that? Because if salaries climbed the same way, it'd be proportional, right? It'd be like, okay, house prices are more, but I earn more. So it's kind of the same thing. People love to bash and to do all this stuff. And look, of course there are rogue landlords. Of course there are bad landlords. But how many people have you seen comment, I love my landlord, looks after me, does all these great things? Not a lot, but they do exist because the majority of people are happy in where they're living. If you look at social housing from like the council and other companies, some of that stuff is disgusting, like would make you sick. And yet that doesn't get talked about as much. So I think it's one of these things, negativity stands on the rooftop and shouts the loudest, but positivity is somewhere sort of down there just whispering. And we love it as humans. The news loves it. Everyone loves getting behind it, this whole landlord bashing thing. But like, it doesn't bother me because I know that my tenants have amazing houses. If things need to be fixed, they are fixed straight away. I've got maintenance plans on everything. So they call my builder and he's out quicker than I even know he's even, out there. I am firm but fair with my tenants. If you don't pay rent, we have a massive problem. If you do pay rent, and you look after the house, like crack on. I'm trying to crack on with life. So are you. So yeah, it makes me laugh more than anything, because when someone has a very different viewpoint, and this applies to all of us, it's very hard to argue with them because you're not going to change their mind. Because I can have one statistic to back up landlords. Someone else could have one against it. And we just keep going until we're out of statistics. And then it just, it's kind of pointless. If someone wants an actual discussion on it, let's have it. But I've just seen some ridiculous things from people who feel so entitled to something. I have mentees who started off working, one of my mentees works 3 jobs. He had 25 grand saved by the time he was 22. Yes, he sacrificed a lot. He hustled a lot. And he's one example out of 100 who won't do this. But he's now bought 11 properties in his first 9 months. He's raised 600 grand from investors. It's not to say that we're all the same and we all can do that, but it's to say there are examples of people who are absolutely killing it. So it makes me laugh and it's fun. And hopefully that clip there will get people riled up, because then they can come comment on my post and we can talk.
Awesome stuff. Awesome stuff. What are you most excited about, I guess, in the next kind of 5-10 years? Where do you see the industry going, and how do you predict things might change?
I mean, I hope that land reg and solicitors all lose their jobs. And what I mean by that is I hope that we can automate an AI and just put some technology in this antiquated roadshow of a shambolic legal system and land registry system and get it moving. Like the land reg website looks like it was made on Microsoft 98. It's just, there's so many, it's a bit like the NHS, I suppose. It's so incumbent as it is and so big and slow moving that it's so difficult to change, so difficult to put new tech in it. So I hope we have property passports, which could be on the blockchain, could be not, but every house and every car should have this as well. And you do get it now, digital service records, but every house should have a house passport, title deed on it, every gas certificate, every electrical certificate, every builder's invoice, just drag and drop, a Google Drive for every house kind of thing, so that when it comes to conveyancing and land reg, we just say, like in auctions, oh, the legal pack's here. Cool. Not, John, can you send over the details a week later? John, can you send over the details a week later? Tej, John has sent the details over. This is what we have to deal with. And so automation, AI, algorithms, whatever you want to call it, technology, bringing stuff into the, 2024, that's what I want to see. And that's what I'm excited for. Do I think it's going to happen? No, not really. Genuinely, I just don't think, I don't know. It will get better. Land reg are, becoming less like dinosaurs, but it's just taking weight. In our companies, we want to change something, we change it, it happens. We're nimble, we're quick. These guys, it's like fintechs. Why is Monzo and Starling, and why are they so amazing? Because they do everything that the big banks don't do, and they're adaptable and they can move. So I'm excited for that. I also buy businesses. I just bought a cleaning business. I'm completing on a food business in a few weeks. So I'm quite excited to not change industry. I'm still doing property, but to explore different industries. And, this morning I was doing a cleaning quote for a company near me, and like just doing different things in different businesses and running different things and playing different games, in different industries is what I'm excited for. But I don't think property is going to change as much as it should do. And I hope I'm proved wrong. I really hope I'm wrong.
So I'm thinking, there's loads that the FCA are talking about now and cautioning like financial advisors around finfluencers, and there's almost like a reaction or a need to react, and the traditional white guys in suits talking about wealth management and hedge funds and that kind of stuff. Like, what would your advice or observations be to engage with people about their money and build an audience and kind of create a message that resonates and motivates?
Yeah, I think a lot of industries have the pale, male and stale kind of thing. And it's so unrelatable. I'm unrelated to it. All my friends are unrelated to it for many reasons. And I think when I think financial advisor, I do think old man in a suit, maybe driving a nice Bentley. So I'm there for the Bentley, but I just kind of think like, do I want to listen to you? You might be wealthy, but if I talk about crypto, oh God, your fucking head blows up. If I talk about, I want to put money in oh no, just put it in trackers, that's my perception. I could be wrong, but that is my perception. Now you mentioned finfluencers. I love that term. I follow some. Is it difficult, again, like in any industry, to identify those influencers who are actually delivering the truth and know what they're talking about? Yes, because I could put a bit of money in stocks and shares. I could have a nice spreadsheet, and suddenly I'm telling you how to manage your money, right? And that is social media. So again, it's very tricky to find the people who are actually telling the truth and not doing it just to sell something. But at the same time, there are a lot of accounts there that don't really sell anything, that if you logically, no emotion, logically look at their pages, you can see that, that makes sense. This much into savings, this much for bills, this much to this. Okay, it's a spreadsheet on how to budget my life. Let me do that. And people are a lot more relatable, whether it's gender, race, beliefs, whatever it is. And so in order to get the message to younger people, to anyone, you want people who look like you, talk like you, sound like you, who have been through what you've been through, who make jokes about stuff that you get, who listen to the music you listen to. Even though they might be unrelated to your finances, you want someone who they kind of had the same upbringing as me. So that means they've probably got the same beliefs I do. So they can advise me based off my situation. So I think it's like finding a mentor who's appropriate for you. You want to scale from, 50 to 100 properties. I'm not your guy. You want to go from 0 to 15, from 10 to 15. I'm your guy. So it's kind of, people need to pick someone that resonates with them, someone that they like, someone that they feel like they're getting to know, someone they could trust. And on the other side of it, the influencers need to, they have a responsibility to be doing and saying the right things, but also they have to realize that not everyone's going to like them or listen to them or get on with them. You will be likable by some and you'll be hated by others. But making finance accessible is a massive, massive thing, especially in some communities with the way you're kind of raised or the way you talk about money. It just isn't conducive to a healthy relationship with money or a healthy long-term relationship with money. Some people have spending problems. Some people have saving problems, have earning problems. So I think getting tailored advice helps. But, I can't see any of my friends at any level of wealth speaking to a financial advisor. I have heard people of my parents' generation speaking about a financial advisor, and I'm always like, ugh, boring, and then they have a totally different view of it. And, people even younger, like Gen Zs, I think they'd be so far detached from that kind of financial advisor because there's someone on Twitch telling them to put money in Dogecoin. There's someone in there saying, do this. And so again, information overload, but there should be a push and maybe some form of regulation or qualification for these influencers who are influencing people's finances.
Super interesting. Well, dude, I've really enjoyed that conversation. Thanks so much.
Thanks for having me.
Cheers, dude.